morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here live from Davos. Now, today we'll be wrapping up our coverage from the World Economic Forum 2023. On the show, we'll be hearing from the UAE Minister for Foreign Trade, Thani bin Hamed Al Zayedi, as well as the Carlyle Group Co-founder, David Rubenstein. But first thing is first, before we get on to geopolitics, let's look at the markets today. Danny Berger is in London. Danny, what do you have?
Hi, Francine. Well, European stocks are trying to claw back from the large losses they posted yesterday. They declined some 1.5%. Where are we this morning? We're up 1/3 So not a huge retrenchment. Still, some of those economic concerns weighing on this market. Speaking of economic concerns, the euro had been up by at least 0.2% earlier. It's come down slightly. But there's still those nerves in this market. We're at around an April high for the euro, with Lagarde saying that the inflation fight, it is not yet done. Of course, she's going to be speaking on a panel there where you are, Francine. The 10-year, that rally is taking a pause. Yields pushing higher by about 3 basis points. But we did start the week at 3.5%, so we have come in since there. NYMEX crude, that is also rising today, almost 1% there. It is headed for a second weekly advance. Now, NASDAQ futures, those are also strong today. I don't have them on the board for you, but we should have Netflix's opening price. Pre-market trading just began. That is up 6.4% thanks to two surprises. One, CEO Reed Hastings is out, but he is leaving on a high note, which accounts for the gains here. 7.66 million new subscribers. Francine, the estimate had been for 4.5 million.
Yeah, it's big news out there. I mean, you stand down as CEO and your share price is up 6%. You wouldn't be too pleased with that. Now, French unions, thank you, Danny. French unions are calling for further strike action later this month after more than 1 million people took to the streets on Thursday. Demonstrators are opposed to the French government's plan to raise the minimum retirement age from 62 to 64. Now, the strikes are the biggest wave of protests since Emmanuel Macron became president.
We can understand that there are some oppositions. We are a democracy, so we fully recognize the rights of everybody to oppose the reform. But we also strongly believe that this reform is a necessity for France. So we will stick to that reform, even if, of course, there will be a debate in the French Parliament, and in the framework of the debate within the French Parliament, there might be some improvements of the reform.
How much France is losing because of the strikes economically? How much are they costing?
I don't think that strikes do have a very important economic impact on the economy, the French economy. The French economy is doing well. We have a pretty strong level of growth. We are creating jobs. We have a high level of investment. We have a very low inflation. So I'm deeply convinced that France is doing well and the French economy is doing well, and I really think that the strikes will not hurt the French economy.
Minister, do you think the US and Europe are aligned on how to treat and deal with China?
I think that there is a slight gap, I would say, and we are all aware of that. The US want to oppose China. We want to engage China. And I strongly believe that in the world game, China must be in. China cannot be out. Let's have a look at the reality. Everybody is speaking about the tensions, the oppositions between the US and China, and the determination of the US to decouple from China. Yes. But the reality is that the level of trade between China and the US has never been so high. So between the statements and the reality, there is a gap. And let's have a look at our own interest. Our own interest, if we want to be efficient and successful in the fight against climate change, is to have China on board. If we want to build prosperity and have more trade, our own interest for both the US and Europe is to have China on board. We want China to obey by the same rules.
The French finance minister there, Bruno Le Maire, speaking with me earlier today in Davos, I have to say he also ruffled some feathers, saying Brexit has been a historic mistake. Now, pressures abroad mean that either higher inflation in Switzerland or a strong Swiss franc. That's the view of the Swiss National Bank Governor, Thomas Jordan. Now, he told me that more tightening could come in order to meet the below 2% inflation target.
Well, I believe there are a couple of reasons. An important one is that energy has a lower weight in our CPI than in other countries. A second point is that we started at relatively low levels of inflation. And the third one, which is probably the most important one, is that we have a very strong Swiss franc. So the nominal appreciation of the Swiss franc helped us a lot. And we let the Swiss franc appreciate already in 21, so we could absorb some of this inflationary pressure coming from abroad.
But so how do you see the complex of inflation moving going forward? We see a, I guess, baseline going down a bit, but core inflation creeping up to 2%. Could this be a problem for the future?
Well, this is exactly, I think, the key point. We have to be very careful. I am assuming that headline inflation will come down everywhere quickly, but we have to focus on the medium to long term, and that means also core inflation. In Switzerland, core inflation is at the moment roughly 2%. We aim at an inflation rate that is consistently below 2% in the medium to long term. Yes. So we do not exclude that we have to tighten monetary policy further.
President, you were one of the first ones actually to hike interest rates, and you've commented in the past that other big central banks should have maybe acted more quickly. Is that still your judgment today?
Well, I think in 21, both fiscal and monetary policy was extremely expansionary, and that pushed inflation down everywhere. We realized already in 21 that there is an increased inflationary pressure. That was the reason why we let the Swiss franc appreciate in nominal term, and that helped us quite a bit. So, and then we started to increase interest rates. Interest rates are still very low in Switzerland. We have only 1%. But as I said before, we do not exclude that we have to tighten further.
But are global central banks behind the curve?
Well, I think every country has to see exactly what is their situation. It's extremely important, in my view, that central banks really commit to price stability, that there is no doubt that central banks will bring inflation down back to 2%, and in our case, below 2%.
Do they need to get there quickly? I mean, you have a small open economy, so of course, if inflation is high somewhere, you get some kind of impact.
Yeah, of course, inflation abroad is a factor that is very relevant for us. So we have to take that into account. When inflation is abroad very high, either we let the Swiss franc appreciate, or we have also inflation in Switzerland.
Well, that was the S&B Governor Thomas Jordan speaking to me earlier in Davos. Now, time for some banking news. And JP Morgan has kept the Chief Executive Officer, Jamie Dimon's total compensation at $35.5 million for his work in 2022. It was a year, of course, in which the firm's profit fell by almost a quarter and the stock notched its worst annual performance in over a decade. Meanwhile, Morgan Stanley Chairman and Chief Executive Officer James Gorman says there are clear signs that inflation is peaking in the U.S. He also told us he has his eyes on China's next policy.
There's clear evidence inflation has in fact peaked and is coming down, right? How quickly, whether the Fed will get us to 2% and when remains the debate. But is clearly the slope of the line is positive, is to everybody's favor. And the second is not just the opening up of China, but China has embraced the rest of the world more aggressively in the last few weeks, witnessed by the Vice Premier meeting with Treasury Secretary Yellen this morning, I think it was this morning, in a way that we haven't seen for some time. So the big question coming out of the Party Congress and President Xi, being re-elected by the Congress, was where does China go from here? Does common prosperity mean effectively dividing the pie up so everybody gets a piece of it, or by growing the pie? And what we're seeing is the tilt is now from divide the pie to grow the pie.
Does that mean you've got more confidence to expand in China?
We've got a very good business in Greater China. Obviously, we have a huge business in Hong Kong, and we continue to have, I think, on the mainland up to 1,000 people in various functions. But no, I think we need to see a little more clarity of Chinese policy. A little more, sober discussion around global trade relations, right now I think we're certainly in a watch, but tilting more positive than we would have been 3-6 months ago.
Morgan Stanley Chief Executive Officer James Gorman speaking to Bloomberg's Lisa Abramovitz in Davos. Coming up, we'll speak with Thani bin Ahmed Al Zayoudi, the UAE's Minister of State for Foreign Trade. That interview is coming up next for the perspective from the Middle East. This is Bloomberg. Economics, finance, politics. Good morning, everyone. I'm losing my voice because it's still so cold. We've had some great interviews, of course, and coverage throughout the week. I'm Francine Lacqua here in Davos. Now, Davos has helped edge investors in an optimistic direction. That's according to the Fidelity International Chief Executive Officer, Anne Richards. Now, we spoke to her earlier and asked her how the current mood is also impacting asset allocation.
I think there is a bit of a disconnect between the fear of systemic risk, the continued drive from a kind of macro-prudential point of view to get as much risk out of the system as possible, against the fact that if we're going to continue to accelerate plans on decarbonisation, to get capital, to get into some of these projects and some of these initiatives so that we can really start to move on the decarbonisation agenda. Also Ukraine up there, there's going to be a rebuilding agenda on Ukraine coming through over the next few years. If we're going to get the capital for that, it needs to come from somewhere. And if you're constantly trying to squeeze the risk out of the financial system, no risk, no return. Yes. So I think there is a disconnect. And I think this week we've seen some of these conversations try to be initiated to bridge that gap, which I think is really constructive.
How do you square that circle?
Yes. Well, I think you need to think about what sort of risks. I mean, the question I've posed to more than one regulator this week is, what sort of risk are you willing to tolerate and where do you want that risk to be? So, is it leverage? Is it liquidity risk? Is it volatility risk? Is it absolute risk of capital loss? What risk are you willing to tolerate? You can't take it all out of the system. How much and where? And think through that framework, because if we have a little bit more guidance on that framework, whether it applies to banks or insurance companies or asset management companies or anywhere else, think about where that risk should sit, and then we can start to figure out how we get the capital to the right places within that context. But I think we need to square that circle.
And you think we'll have answers pretty soon?
You're talking about regulation, right? Nothing is ever pretty soon on that. But I think we can see a little, if we can see a little bit of a change in thinking and approach, I think the FSB and other regulatory umbrellas like that can help us think through where do we want that risk to be, and then we can start working on constructive suggestions.
What's your outlook for active investment managers in 2023?
I'm an active investment manager for the most part, therefore of course I'm positive about it. But I think it's been fascinating. I think you have, if you look at the C-suite in the companies that we follow, the many thousands of companies that we follow around the world, companies have had to deal with a lot over the last 3 years. They're very seasoned. They understand how to react quickly when they need to. That muscle is really well developed, and it's more, businesses are more resilient than they were for sure. So what we can see is that, as the world chucks different things at us. I sometimes call it, we're in like this kind of multiverse, everything everywhere all at once. Stuff keeps happening, right? Companies are better at adapting, and we are seeing the move to digitization, the move to automation, building, broadening supply chains. That's happening quite quickly. And for active managers, we can differentiate between the companies that really get it and are moving fast on some of this stuff versus some of the others. And that is a great environment for an active manager. So I think we're pretty positive. We do see stuff coming through now that we get quite excited about.
Do you have hiring plans, or will you get bigger?
So hiring is interesting because I think everybody knows everywhere. Actually, the war for talent has been really tough. Some of the challenges have been actually, how do you hire people?
And finding the right person.
It's finding the right. We are increasingly tech businesses, and we're putting a lot of emphasis on that. Now, if you go back, I was speaking to the head of one IT services company yesterday. A year ago at this time, they were experiencing well over 30% attrition. By the end of the year, it was down to 20%. First quarter actually has started, it's like 11% annualized. And I think that's quite interesting. So I think the attrition environment has improved. That means you don't need to hire as many people because you're not replacing those that have gone. But I think it also shows you that this sort of spur towards automation, which when unemployment is as low as it is, you need that automation, that productivity improvement. So I think you see a changing shape in our industry, and that's kind of what we're saying.
Well, that was the Fidelity International Chief Executive Officer, Anne Richards. Now, we're also looking at live pictures that are of the Rubenstein military air base in Germany. The U.S. Defense Secretary, Lloyd Austin, giving opening remarks ahead of a key meeting with NATO defense ministers. Now, the U.S. has announced it's sending fresh aid to Ukraine. That includes over 100 armored vehicles. Later on Bloomberg, we go to Berlin, where we speak to one of the most outspoken defense hawks in Chancellor Olaf Scholz's coalition. Now, it's the final day of the 2023 World Economic Forum. We're still bringing you all of the best interviews from the world's top leaders in industry and politics. This is where we focus, of course, on some of the great interviews that Manus Krani has been bringing, and, of course, perspective from the Middle East. Manus, over to you.
Francine, thank you so much. We brought in the UAE Minister of State for Foreign Investments. It is Thani Zoudi. Minister, thank you very much for joining us. There is this building consensus at this Davos that the worst is past, that we're going to have a very mild recession, and that we've passed the worst that we felt before Christmas. Would you agree with that? Just let's start there.
I'm very optimistic. Looking at the numbers in the last quarter of 2022, the prediction was much worse than what we achieved globally. And the expectation for this year is very pessimistic. But from the discussion, I'm very optimistic that we'll exceed all the numbers which has been predicted. And even when it comes to the recessions, I don't think there will be a major recessions globally. It's going to be very mild or even much.
Do we escape in the Emirates? Do we escape any downdraft? Are we immune?
We're very immune. We did very excellent last year, and we're going to do an excellent performance this year as well.
Your job is to bring home the free trade agreements. That's what you hear talking about. I understand there's 3-4 more free trade agreements to come. Let's break some news. Will you tell me who they are that'll come near term this year?
We're going to conclude with Cambodia next month, and we're going to conclude with Georgia the month after. So first quarter, we're going to have 2. We're almost done with Turkey. It's the last step, usually takes a bit longer. And we're kicking off with Ukraine this month. Hopefully, we're going to conclude before the mid of this year, and more to come.
What about the Philippines?
Philippines, we're in discussion. We initiated this discussion last year. The government election happened, slowed down, but reactivating the things now.
So, look, this is the escalation of the policy you and I caught up with last year at a federal level when it was launched. That clutch of additional free trade agreements you just announced, how much more will that do for the economy?
This is going to boost at least 3.4 to 3.8% of our GDP by 2030. So this is another big boost to our GDP.
You've also you signed the FTA with India last year. There's a huge contingency here. Rupee dirham trade, I understand, is set to happen when, and what kind of commodities will you settle in rupee?
We're still in early stage discussion with India on this dirham rupees trade, and this is going to be focusing only on non-oil trade because of the other factors. It's at early stages. The minute that things are done between our central bank and the counterparts in India, things are going to move.
Is the infrastructure between the central banks there? Is it just a question of getting the last T's crossed and I's dotted? Is the infrastructure there?
Well, it's technicality. I will keep it to the financial people, but it's still at early stages.
I don't want to make the same mistake as I made with the Saudis. Can we just square it away that you're not going to trade? Are you going to trade oil in rupee? Is that something the UAE would or would not consider?
No, it's not under consideration.
Okay, that's squared away. Obviously, there was a huge contingency in Saudi Arabia from China. The Emirates were there. All the GCC leaders were there. How close are you to a China FTA? Was there significant progress made? Any constructive discussions?
The discussion is happening. The negotiation is happening on the GCC front. We're part of the negotiation. Things are progressing. It's taking, as usual, longer than the bilateral, which is the natural of the negotiation.
What do you want from China? What do you want that relationship to be?
Well, with China is our first trade partner, and for sure more is going to be good for consumers, for workers, for peoples, for businesses.
But do you want that to be tech? Do you want that to be manufacturing, Thani?
We wanted technology, we wanted industry, we wanted services, which we are very strong with, and we want it for our main industrial and export products.
The other dynamic that you and I touch on from time to time is tax. We have corporate tax going live in the UAE in the middle of the year. And the last time we chatted, you said, look, it's about a balance. I'm going to remove certain fees when I put this corporate tax in. We've just had a massive alcohol tax reduced. What other business fees can you tell the audience today that you're really considering reducing?
Well, there will be an overlap for some time between the normal fees and the corporate tax until we know the basis and the foundation. And things will be left out. So it's going to be taking some time until things are going to be balanced. It's the first time we're applying it. It's going to take some time. The good thing about it that we're not going to apply the corporate tax on anything below $100,000, which just to make sure that SMEs are benefiting from the new ecosystem that we're encouraging and pushing for in the country.
Two things that the UAE are benefiting from. One are passports and that ability to get a passport while Europe closes those doors. How many passports did you issue to non-Emiratis last year? It's a big business.
Well, I don't have the number, Manos, on this, but we want people to feel home. So it's not only about the passport. It's the golden visa, which they feel that they're attached to the country and the whole ecosystem. There's no big differentiation between locals, residents, and the one who wants to live in the country. And that's why it's part of our welcoming signal to everyone. The UAE is a center to do your businesses and to grow from the UAE.
Let's just close off on the tax, because I come from Ireland and they made hay with their corporate tax reduction. Taxes are rising in Europe and in the West. Here you are at 9% corporate tax. How important is it that that is continuity, that that's not going to ratchet continually upwards? Taxes rarely go down, Minister, as you know. What is the message on tax continuity? If I look at the EU at 22%, globally 23.5%, you're 9%. Message to the market on tax continuity?
We're always going to be an attractive hub and center destination to all businesses, as low as possible when it comes to taxes.
Danny, thank you very much, Minister for Foreign Trade from the UAE. My final interview here from the slopes of Davos. Lovely to be with you, Fran, on the first one. Fran.
Manas, thank you so much. Thani bin Ahmed Al Zawadi, the UAE Trade Minister there, Foreign Trade Minister. Now, we're also looking at live pictures of the Rubenstein military airbase in Germany, where defense ministers of Western nations are meeting to discuss weapons donations to Ukraine. Now, just ahead, we get the view from Germany. I have to say we've gotten the view from Germany pretty explicitly over the last 4 days ago. First of all, here in Davos, we've had huge delegations. We spoke to the economy minister. He was very clear about what was needed in terms of military help. And then our editor-in-chief had a great conversation with the Chancellor, also Olaf Scholz. We'll be speaking to the Bundestag Defense Committee Member, Markus Faber, one of the most outspoken defense hawks in the Chancellor Olaf Scholz coalition. But first, let's listen in to this press conference in Rubenstein.
And as the United States increases our support on multiple fronts, we're also prioritizing accountability with cooperation from the Ukrainian forces. And we're proud to stand together with our valued allies and partners to support Ukraine's self-defense. Poland has been a leader in providing armored vehicles, in training Ukrainian forces, and in providing shelter for Ukrainian refugees. Our German hosts have announced that they will also provide a Patriot air defense system for Ukraine, complementing our own Patriot contribution. Germany will also donate Marder infantry fighting vehicles for Ukraine. And last week, Canada announced that it would provide a NASAMS air defense system to Ukraine. Now, that's a major investment in Ukraine's ability to defend its skies. France also announced a significant donation of AMX-10 light tanks. And many European countries have announced their own training initiatives as a part of the EU's military assistance mission to Ukraine. These announcements, especially on air defense donations, are direct results of this contact group.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos, Switzerland. Now, you're looking at live pictures of the Rubenstein military airbase in Germany. This is where U.S. Defense Secretary Lloyd Austin is giving opening remarks ahead of a key meeting with NATO defense ministers. Now, the U.S. and German defense ministers are discussing tanks for Ukraine amid differences. It is actually the first time that the U.S. Defense Secretary meets the newly appointed Germany Defense Minister Boris Pistorius. So we'll see how that goes. Now, in an exclusive interview with Bloomberg this week, the German Chancellor Olaf Scholz reaffirmed his support for Ukraine.
We always act together with our allies and friends. We are never going alone. We support the Ukraine as long as it is necessary with all the means we can use, but also always avoiding that this war is escalating to a war not between Russia, which is the imperialistic aggressor, and Ukraine, but to avoid that this is going to be a war between Russia and the North Atlantic Treaty Organization.
The German Chancellor Olaf Scholz speaking to Bloomberg's editor-in-chief John Micklethwaite in an exclusive interview earlier this week. We also spoke to the economy minister, of course, of Germany. And then on the other side, we spoke to the Polish prime minister saying, look, he has the tanks available, but he's just waiting on the stamp of approval from Germany. So for more on all of this, let's bring in Oliver Crook in Berlin, who's joined by someone who definitely knows a little thing about defense. Ollie.
That's right, Francine. Thank you very much. We're joined by Markus Faber. He is an FDP lawmaker. He sits on the Bundestag Defense Committee. He just got back from Ukraine a week ago. Welcome. Thanks for joining us this morning. Let's begin with the topic that everyone is talking about today. That's at the Rubenstein Air Base. Tanks. Will Germany send tanks? You stand notably, you're part of the government, you stand notably in opposition to their stance on not sending the tanks. Why is Olaf Scholz wrong?
There's a debate in the coalition whether to send battle tanks or not. I've been in Ukraine for 9 days, and there was not one discussion where Leopard 2 was not mentioned. So I think our chancellor says we should not go alone, but when everybody is going in Europe, Polish are going, Finland is going, Great Britain and France, we should also be not left alone in Germany. So I think we should do what our partners are doing, and we should also deliver battle tanks to Ukraine.
Do you think we'll have meaningful movement on this today in the discussions that are going on right now? Do you think that Germany will approve either sending the tanks themselves or give permission for other nations that hold those tanks to be sent to Ukraine?
Yes, I do think so. Yesterday was the first day of work for our new defense minister, Boris Pistorius. So he has a lot of questions, and I think those questions can be answered today. And I think with some convenience and some discussion between our partners, he will be convinced, and we can also give the permission to other countries to deliver Leopard 2, but we can also deliver ourselves to help Ukraine against the Russian aggression.
Markus Faber, good morning from Davos. We had great conversations here also on the ground with the finance minister, with the economy minister, and they were very cautious about actually going ahead with this plan. What do you think is holding them back?
I think what's holding them back is the current discussion. I think the aim of Germany is to go allied with its partners in the NATO, with its partners in the European Union. So we did a lot of military support, we did a lot of financial support, and we will continue this. So we have laid the groundwork for this in our budget for 2023. Yeah.
But there must be an underlying reason why they're so reluctant. We also spoke to the Polish prime minister, and he says, look, it's maybe because of the history of the country. Why do you think for the moment, ahead of the discussions, we almost had a very cautious stance, if not a no, from the German government? Germany
is a very pacifist country, obviously because of our history. And I think the idea to defend democracy with military issues is very new to Germany, and that is something that the USA, Great Britain and France are much more used to. So there's a learning process in Germany, and that has not come to an end yet.
Do you worry that there is so much high-tech, high-powered artillery, tanks, weapons of the highest grade being sent to Ukraine, and once we have peace, we don't know what to do with all of these materials, that it could go in the wrong hands? Should we start thinking about that now?
The Ukrainians have been very, very responsible with all the armament, all the military aid we gave them. And I think something has to be clear. A small Soviet army cannot beat a big Soviet army. So the only way for Ukraine is to have modern Western weaponry to actually fight off the invasion and to defend their own country. This is the only way to solve this issue and to prevent Putin from also invading other countries.
And are you concerned at all about one of the things that Olaf Scholz has pointed out, and I think everybody's very conscious of, is over-escalating the conflict? It's very difficult to anticipate how Putin views these things and where the red lines are there. If not tanks, where is the sort of red line for Western support of Ukraine, do you think?
So what's the over-escalating? I've stand next to mass graves in the city of Le Mans. I've been in the torture prison in the city of Kherson last week. So what kind of escalation when it comes to war crimes is there? I think it's not escalation we see from the Ukrainian side. It's a Russian invasion. And we are helping the Ukrainians to fight the invasion off. So I think Ukraine is not invading. They have been very responsible also to just use the weaponry we give them on their own soil, I think, which is very hard for them. So I think by what they did right now, they have really earned more support by Germany and other countries as well.
Yeah, but Mr. Faber, we do hear, especially here on the ground, from politicians and also, very prominent thinkers of world history, that they don't want to do anything that could aggravate Vladimir Putin at this point. So weaken, yes, the Russian army, make sure that Ukraine wins without aggravating him. When Putin says that he's ready to use nuclear arm, do you believe him?
The Russian military doctrine is very clear on that. Russia is supposed to use nuclear arms when the existence of Russia is scared. This is not the case. The Ukrainians will not be in front of Moscow tomorrow, whatever we do. They are trying to fight off the invasion troops from their own soil. And when they have finished this job, they will be very happy to go to peace again, because the Ukrainians are paying the highest prices. I've talked to soldiers that had been in combat. I have talked to soldiers that had left legs, and everything they want is peace, but not peace under all circumstances, but peace in freedom and peace in justice, and that's what they are fighting for. And I think they have the most interest to have it as soon as possible, as soon as the invasion troops go home.
And Poland says that they are considering sending tanks these Leopard tanks without the permission of Germany. First, what do you think about that? And do you think that there's a risk of sort of unity in the West kind of falling a little bit apart or being fractured?
There are contracts between the partners in Europe. So all the countries that gained Leopard 2 from Germany signed that they will just export them when there's a license and export permit from Germany as well. So I guess the Polish will stick to it, and even more important is that Germany gives them those export permit.
Great. Well, thank you so much, Markus Faber. He's the Bundestag Defense Committee Member and a lawmaker for the FDP. Fran?
Yeah, a great conversation there, of course, on where we go forward. For the moment, we don't see much consensus. So we'll have plenty more, of course, from Davos and beyond, as we also follow what's going on over in Germany, where we're expecting negotiations on sending tanks. We spoke to the economy minister of Ukraine. We spoke to the Polish prime minister. We also spoke to the Polish economy minister. And, of course, all of their focus, especially when you look at Poland, and the fact that they're a front-line country, the fact that there are more than 8 million refugees from Ukraine crossing into Poland, with 2 million of them actually settling, means that this is something that we not only need to talk about, but also find not only maybe a defense, way forward, but also we need to talk about rebuilding and the economy and extra support in terms of financing. Now, coming up, don't miss our interview with David Rubenstein, co-founder and co-chairman of the Carlyle Group. That's next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Ahead of Lunar New Year on Sunday, China's COVID czar says infection levels have dropped to a relatively low level. Outgoing Vice Premier Sun Chulen said China's doing a good job as it moves to a new stage in the pandemic. Chulen previously spearheaded Beijing's hardline approach to the virus. Now, Netflix co-founder Reed Hastings is stepping down as CEO after more than 20 years. Greg Peters, previously the chief operating officer, will join Ted Sarandos as co-CEO of the streaming giant. Shares jumped after hours as Netflix reported almost 7.7 million subscribers in the last quarter, well ahead of estimates. Netflix is also forecasting improvements to its profit margin and free cash flow in the coming year. Now, French unions are calling for another national day of strikes on January the 31st, unless President Emmanuel Macron backs down from his plan to raise the minimum retirement age from 62 to 64. Railways, schools and the energy sector were all disrupted in yesterday's mass walkout. Unions say 2 million people took part in marches, double the government's estimates. The Netherlands and Japan are close to joining a Biden administration-led effort to restrict exports of chip technology to China. Sources tell Bloomberg that Dutch and Japanese export controls may be agreed to and finalized by the end of January. The two countries are home to key suppliers of semiconductor and manufacturing equipment. The EU has fined Meta's WhatsApp 5.5 million euros and given the companies a 6-month ultimatum to bring its data processing in line with EU law. The privacy watchdog says WhatsApp violated data protection rules by forcing users to opt in to data processing without clarifying what the information would actually be used for. Meta, Facebook and Instagram were all fined earlier this month. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, it has been an interesting Davos. For as much as a lot of people came, the UK delegation was not that present, especially if you look at different years. The Prime Minister, Rishi Sunak, did not come. His Chancellor did not come. However, the opposition came. They were very visible. They were at all the parties. They were on a lot of panels. And we caught up with the Shadow Chancellor, Rachel Reeves. And I asked her simply what she wanted to achieve in Davos.
The only way to resolve these industrial disputes is to get around the table with the people who work in that sector and the trade unions that represent them. We heard from the head of the Royal College of Nursing before Christmas that she was willing to call off the strikes if only Rishi Sunak would get in a room with her and have a meeting and discussion. The RCN and others have said they are willing to negotiate on pay, but to negotiate, you need a partner to negotiate with. And we're now in a situation where the railways, the nurses, the ambulances, the teachers, industry after industry taking industrial action at a time when our economy desperately needs our public services to be functioning properly, and when our public services are not just on their knees, but in some cases flat on their face. And the government have got to take that responsibility and negotiate. Now, look, I'm not going to just pick numbers out of the air. That's not what we would do in government, and we won't do that in opposition either. But if we were in government today, we'd be round that table resolving this dispute. That's what Labour did when we were last in government, which is why we didn't see industrial action on anything like this scale.
Inflation was, not as high as now, so it's a little bit of a different kind of environment. Are you worried that this will just last on unless they get fair wages or higher wages, even if it's not what they ask, at least much higher than they have now?
Anyone in business knows that disputes are only resolved through negotiation and discussion, and also a building back of trust. And that trust between the government and so many public sector workers has been undermined by the way they've been treated. A couple of years ago, we were all in Britain standing on our doorsteps clapping the nurses, and the government just this week introduced into Parliament legislation that will make it easier to sack nurses if they take industrial action. That is no way to treat key public sector workers. Labour wouldn't be doing that. And the risk is that that sort of legislation to make it easier to sack public sector workers is only going to make these disputes worse. It's not going to resolve the problem.
Well, that was Rachel Reeves, the UK Labour Party Shadow Chancellor of the Exchequer. Now, the one thing I did ask about the strikes, we did also talk about why she was in Davos. She wanted to talk about to the business community. So let's get the view from the UK and what he's been following, who he's been chasing. He's the one and only Phil Aldrich. Phil, thank you so much for joining me. We also did a podcast at the beginning of the week saying what Labour's messaging here would probably be. What have you been most surprised by?
Well, they've had a pretty positive reception from the business community, because obviously Jeremy Corbyn really set back Labour among corporates and executives, and so there's been as one leading banker put it, they've been happily surprised. They're surprised on the upside by briefing. Well, they had breakfast and they had private meetings. So there's been a lot of business people who've been meeting Keir Starmer and Rachel Reeves, and so it's worked. They've built some relations here with this community.
Phil, I mean, it's very clear that the Labour Party, the new Labour, basically Tony Blair won because he had the business community on side. Are they going to be the final decisive, factor, given the kind of upheaval we saw in the UK economy?
Yeah, the point about getting the business community on side is not that their votes necessarily matter, but it's the endorsement of the business community provides the sort of security of among the general public that this is government that means business, and that this is a government that can be trusted, and so that's the vital sort of element that they're trying to win over. I mean, they haven't just come to Davos out of the blue. They've been doing this for over a year. They've been having meetings and lunch meetings, and they've eating a lot of sandwiches, drinking a lot of coffee, and getting to know these people. And they're saying, familiarity is what is going to help the Labour Party, because obviously there are lingering concerns. As Grant Shapps, the business secretary, said, Keir Starmer was part of the cabinet under Jeremy Corbyn. So how has he changed? Does the leopard change its spots? It's that kind of issue. So the familiarity, the more they get to know them, the business leaders are feeling more and more comfortable with Reeves and Starmer.
Phil, thank you so much. Phil Aldrich there, braving the wind, braving the corridors to really chase a lot of the UK delegation down and trying to get some comments from them. Coming up, don't miss our interview with David Rubenstein, co-founder and co-chairman of the Carlyle Group. That's coming up next, and this is Bloomberg. Our WEF 2023 coverage from Davos continues this hour. Joining us now is David Rubenstein. He's co-founder of the Carlyle Group. David, thank you so much.
My pleasure.
A Davos veteran. What's it like for private equities in 2023?
Well, private equity people do come to Davos. We've been coming for quite some time, and you see a lot of your investors here and a lot of other people that you want to do business with. So it's very productive, I think, to be here.
Well, how is the allocation of capital changing, given interest rates are rising, but also the world economy and geopolitics is changing everything?
Well, first thing you should know, or I like to remind people, is when the economy is a little bit tricky, sometimes that's the best time to invest. You don't really want to invest when the economy is doing well and everybody's saying how great it is. So there's some challenges in the economy, but it's actually a good time to invest. The prices are going to be lower. We have a fair amount of capital to deploy in the private equity world. Debt is more challenging to get, but a lot of deals in private equity don't require that much debt compared to what it was many years ago. It used to be you borrowed 90% of the purchase price. Now it's much less.
Valuations are still quite high with some of the companies and actually private equities, but also venture capitalists hold. When do they come to a more realistic perspective?
You always have this problem when you have a potential recession coming, because people who are sellers want to kind of sell out before the recession comes. The buyers are afraid that they're going to be buying into a recession price. So you have a gap of maybe 10 or 15%. So it does take a while to get deals done, and there are fewer deals getting done last year than we would have liked. This year, I suspect they'll be better.
So what does it mean for financing and lending actually in your space? Do you need to become bigger to weather the storm?
Well, obviously, there's some big firms, and they are doing pretty well, but there's plenty of room for small firms. There are about 20,000 different private equity firms in the world of all different types. So I'd say the private equity industry has done quite well. We've done much better in giving the returns that people wanted than people thought we would in this environment. I think the industry's in pretty good shape.
What industries are you most interested in at the moment?
Well, let me mention one, healthcare. When I worked in the White House, probably before you were born, but it was in
You're too kind. It's a lie.
1977 and 1981 for President Carter, the GDP of the United States in healthcare was 7%. Now it's about 22%. And why is that? Well, people are living longer. They want to spend more money to live even longer. People have all kinds of access to better health care. I mean, not everybody does, but if you have the ability to afford better health care, people want it. And so health care expenditures are going way up. And also people are living much longer, and that generally requires more health care expenditures.
But how do you play that? So is it biotech? Is it the AI, for example, that folds the protein so you find the drug that you need quicker?
Well, obviously, the biotech is one thing. That takes a long time usually for things. But I think one of the things we learned during COVID is telemedicine is actually pretty attractive to people. You don't have to go to a doctor, and a doctor can actually analyze your charts and so forth and give a diagnosis over the telephone or over the Zoom, and that's really taken off a fair bit. Also, around the world, as the world is getting wealthier in certain parts of the world, people there are saying, well, I want to live longer too, and so they want better access to medical treatment. So when people get wealthier, what do they want? They want better food, they want a better, longer life, more health care, and obviously all this for the children as well. And as the world is getting, in some parts of the world, wealthier, you see more healthcare expenditures going up.
David, thank you so much for joining us. David Rubenstein there with his latest thoughts, of course, on the private equity. He's a co-founder of the Carlyle Group, and we'll have plenty more from David throughout the day. I'm a big fan of your show, David. So
thank you very much. It's
keep
on a
it
very
going.
good network.
It is on a great network. Coming up, Mike McKee speaks exclusively to the outgoing Kansas City Federal Reserve President Esther George. Don't miss that. That's it for us from Davos 2023. We've had some great interviews. We've spoken to prime ministers. I think three main themes. Inflation, what does that mean for the allocation of capital? Why we have not seen more zombie companies given the trajectory of interest rates rising so quickly. And of course, then geopolitics at the forefront with Prime Minister Morawiecki of Poland asking really the U.S. and allies to send more tanks to Ukraine. This is Bloomberg.
Inflation is coming down in America. Prices are still too high. We have a lot more work to do, but things are getting better, headed in the right direction.
It is not the end. This is not the time to get complacent. There is a lot more to do.
We can do this if the Fed is determined, if the people are supportive of the Fed, if they realize this is the best way to get the inflation down. It's not by waiting and dilly-dallying. It's really by taking the action right now.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. The Fed's likely to downshift on the pace of tightening today, but it will probably signal that interest rates will go higher than forecast. It could be a sign that the cost of living squeeze in the UK is now past its peak. Inflation dips slightly from a 41-year high. And former crypto mogul Sam Bankman-Fried doesn't want to return to the United States to face fraud charges. He tells a judge in the Bahamas he plans to fight extradition. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Well, inflation coming down in the US, Kailey, coming down actually here in the UK as well. That part of the focus over in the Asia session as we work our way towards the Fed.
Yeah, and the other focus in Asia, although news crossing just now, so it was too late for the Asian equity session overnight, the Bank of Japan is said to see the possibility of conducting a review next year. So very interested to see if there is any kind of policy shift from Kuroda and Co. as they continue to have yield curve control, continue to keep policy easy as central banks around the world are tightening, with the Fed set to do even more of that today. So that definitely something to consider. But again, Asian markets are already closed for the day, and it broadly was an up day in Asia. Is that more to do with optimism on the inflation slowing story here in the U.S., or maybe the growth story in China, with them continuing with the reopening of the economy, even as cases rise, though they aren't even going to count all cases anymore, only symptomatic ones, apparently. The MSCI Asia Pacific Index up about 1% overnight. It is now at its highest since August, so more than 3 months, and right on the cusp of a bull market, is up almost 20% from its low in October. In foreign exchange, the Chinese yuan is strengthening against the U.S. dollar by about 1/4%. 6.94 or so is where we trade. But interestingly, the only G10 currency weaker against the U.S. dollar today is the Kiwi, the New Zealand dollar, trading around 64 cents on the dollar, and that is after the government there said they do see a recession next year, beginning in the second quarter and lasting for 3 quarters. So that's something to keep in mind. And of course, the recession outlook, the inflation outlook, what it all means for central banks is what bond traders continue to contend with. And as they did so in the overnight session, largely yields were moving lower, including in Australia, where the 5-year yield was lower by about 4 basis points ahead of the Fed, Matt.
All right, we do see a weaker dollar really across the board, as you said, Kailey. In fact, right now we're looking at $12.50 in the Bloomberg Dollar Index, off about 1/3 of 1%. And I think it's about 8% lower than the high that we reached, something about 1353, 1355. S&P futures are unchanged right now, which is interesting. We had a decent run yesterday. We were up at one point to 4,100 on the S&P 500. Those gains dissipated. We finished the day up about 0.7%. And right now we're not doing a lot in terms of futures. Of course, we're waiting for the Fed decision, waiting to hear from Jerome Powell, and Bloomberg will have special coverage of that. The Fed decides starting, I think, 1:30 p.m. this afternoon. NYMEX crude right now up about 0.5%, 75.77 a barrel is the level for WTI, which is pretty amazing. We've seen more than $5 climb since Monday morning, and it's only Wednesday. Bitcoin also up right now about 0.25%, $17,806. So Bitcoin continuing to climb in December after, it dropped to 16,000 in November and then held there for pretty much the entire month. And now we're looking back towards 18,000 for a level. Anna, what do you see in Europe?
Yeah, interesting. You mentioned the oil price up 6% in just 2 days, Matt. Such has been the retracement higher that we've seen in oil prices. This is what we have for Europe. European equity markets then looking weaker, looking sluggish, not really finding any reason to head higher this morning. The FTSE 100 down 0.4%. The CAC and the DAX down a little bit more than that in the Eurozone. So European equity markets are sluggish. One sector stands out to the upside. That's the energy sector. And we have seen the oil price recovering a little bit over the last couple of days, and that is positive for energy stocks. That sector up by 0.4%. Outside of energy, all sectors heading south. OMV is one of the energy names in focus, up by 3.3%. This business, based in Austria, but speaks to a wider theme. They have introduced a special dividend. That's why that company is trading higher today. TUI is a company based in Germany, and this is to do with the travel and leisure sector. A tour operator provides holidays. The stock down by 6.4%. They're talking actually quite bullishly, Matt, about how the business is trading right now, about where the business is going. But they're also having to issue shares to try and repay back the German government for some of the loans that they received during the height of the COVID pandemic. And so we're still dealing with all of that, of course, and that business trading weaker as a result. 123 on sterling, so slowly going higher on the pound against that dollar. So 123.83 as we head towards the Bank of England tomorrow. Could we see a four-way split decision? We got the inflation print here in the UK earlier today. More on that in just a moment. But a 41-year high inflation, could it be high on inflation? Could that now be behind us as we tick down slightly, but still in double digits, headline inflation here in the UK, Matt?
All right, so we're continuing on inflation watch really around the world, but the good news is it looks like it's coming down. That's good news for central bankers, and it's a busy week for their decisions, with the Federal Reserve, of course, kicking it off today. Fed policymakers are widely expected to raise rates by 50 basis points. The announcement is due at 2 p.m. New York time. Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now for more on what to expect. So I guess, Mike, today's decision is baked in, but we're looking to see what Powell and the Fed say about February and further.
Yeah, man, it's a little weird. It's sort of like we're all going to a show, but cast members have been out telling us what the plot is throughout the last couple of weeks. We're pretty much certain of what's going to happen today. As you mentioned, a 50 basis point increase that would put the target rate between 4 and 4.25%. We'll also get a reminder that they're going to keep raising rates. They probably won't put a number on it. They will also warn Wall Street that once they get to the peak rate, they're going to keep it in place for some time. The word from the New York Fed President John Williams was it would be throughout 2023. It's going to be interesting from a market standpoint how much information they get on that. And then we're going to get new economic forecasts and a new dot plot. Now, you take a look at the dot plot, and there's a couple of things going on there that are important to note. One is that 2023 refers to the whole year, so that's not going to immediately tell us where rates will be at the end of the year, but we will see if they think they need to move it higher. And the red line there on the bottom, and for those of you on the radio, you've got sort of two parallel lines with the market anticipating rate cuts coming during the year, and the Fed in its September projections making no rate cut forecasts. Will that change? Also on that chart there, and I'm sorry you can't see it on radio, but you do have a big spread in 2024 among the members of the Fed? Are they going to compress that like 22 and 23? And are we going to see more unanimity about where rates go? Or are they still going to be very uncertain? We're looking at market rates. We're seeing that markets do anticipate that by May, and this is from our economic analyzer, by May we're going to see the markets expect the Fed's target rate to be well above the inflation rate. And that's a good stopping point historically for the Fed. So there's going to be probably a takeaway from this meeting, guys, that we're going to see some dispute over how high they have to go and how long, and whether the markets will buy that or not.
Well, on the subject of dispute, Mike, at the November meeting, the statement said one thing and was perhaps a bit more dovish, and then Jerome Powell at the press conference had a very different tone when it was just himself at the podium. Could we see a kind of replication of that divergence again today?
You could. I would anticipate that the statement wouldn't change a whole lot unless they have a desire to really move the markets. And so we will look for Powell to give us clues to what the Fed's thinking is in terms of how long they keep rates high and what they might do at the next meeting. Implying that we have another 25 or 50 basis points to go doesn't tell you when they're going to get there.
All right, Bloomberg's Michael McKee reporting from Washington, gearing up to ask his question in the press conference later on today. Thank you so much. Now, as we talk about Fed policy, let's also recap that breaking news on BOJ policy potential changes. The BOJ is said to see a possibility of conducting a policy review next year after wage growth and any slowdown in the global economy are closely examined. Bloomberg reporting this according to people familiar with the matter. And of course, in the past, reviews from the BOJ have resulted in changes to policy, including the introduction of the yield curve control program. As the market digests this, we saw a sudden strengthening in dollar yen. It has shifted back to essentially where we were before. Around 135.07 is where we trade on dollar yen at the moment, Anna.
Yeah, a lot of people asked during that period where rates globally just seem to be going higher and higher as central banks hiked. A lot of people asked how long that yield curve control policy could be maintained. So we'll certainly watch that one. Here in the UK then, Kailey, inflation dipped from a 41-year high in November, but it may be too early to claim the worst of the cost of living squeeze is over. Joining us now is Bloomberg's Lizzie Burden. Lizzie, could this inflation print move the needle for the Bank of England? Is it in any way a change to their thinking?
Uh-oh.
I'm not sure we're hearing
Tomorrow.
Lizzie. So we'll try and fill in some of the blanks. We got that move away from a 41-year high on inflation. Let's get back to Lizzie Burden. Lizzie, I think you can hear me, and hopefully we can hear you. So I was asking if this changes the Bank of England's thinking.
Well, Anna, this is a bittersweet pill for the Bank of England. I don't think it really moves the dial for the bank at its decision tomorrow. On the one hand, we have seen that inflation has probably passed its peak. In fact, inflation in the UK is now lower than it is in Italy and Germany. And it's been a decline because of petrol, used cars, tobacco. It was a lower than expected print that might embolden the doves like Silvana Tenreiro, Swati Dhingra, who are very concerned about the recession risks, the risks of an aggressive big hike taking effect just as a recession is in at its biggest stage. However, this print is still, let us not forget, 5 times higher than the Bank of England's target. You've got services inflation at a 30-year high. That too will embolden the hawks. So at the moment, we're still expecting a half-point hike from the Bank of England, same as we're expecting from the Fed and the ECB.
All right, Lizzie, thanks very much. Bloomberg's Lizzie Burden there talking to us about maybe the peak has been reached in UK inflation as well. Let's get back to, I guess, the big water cooler story. FTX co-founder Sam Bankman-Fried plans to fight being sent to the U.S., fight extradition. In his first court appearance since being arrested, he told a judge in the Bahamas that he will not waive his right to the extradition hearing. Ari Redbord, head of legal and government affairs at TRM Labs, spoke with Bloomberg on what this means for Bankman-Fried's case.
This fighting extradition will ultimately end up delaying the criminal process, which I can imagine a world where the SEC case, the CFTC, and civil plaintiffs' cases will ultimately be stayed pending the resolution of the criminal case. And the longer extradition takes, the longer the preliminary stages take place once he's ultimately extradited, if he's ultimately extradited, just delays things further and further.
Joining us now is Ana Herrera, Bloomberg senior crypto editor. So, Ana, where does Bankman-Fried's extradition case stand? I mean, how long would it take?
Could take years, really, if they decide to go that way and battle the extradition. Obviously, he doesn't want to waive his rights, but we don't know if ultimately they'll decide not to fight the extradition. There are pros and cons to staying in the Bahamas or going to the U.S. But it's obviously, like as you said, a water cooler story. There's so much to watch here.
Yeah, there absolutely is. And of course, this has ripple effects beyond just FTX and Sam Bankman-Fried. Binance, another exchange which had gained some market share in the wake of the collapse of FTX, is now dealing with billions of dollars of outflows. What's going on there?
Yeah, so obviously there's been a sort of loss of confidence in exchanges ever since FTX collapsed. You can imagine if you had your money on FTX in a week's time, that was lost, so you might be worried about your money on other exchanges, and that's leading to withdrawals and people yanking money from exchanges in general, but obviously Binance being the bigger, sees bigger withdrawals. They've come to reassure, CZ has reassured sort of investors saying, this is normal. We've had days with big outflows, net outflows too, and we can handle it. We have money. If you come and get your money, we'll give it to you. So, but clearly, the confidence is shaky. If you can imagine, no one, I imagine, would have expected such a swift and chaotic collapse of FTX.
All right, Anna, thanks so much for joining us. Bloomberg's Anna Herrera talking to us about the aftermath of the implosion of FTX. Let's get to a company that's big and maybe a little bit too big and healthy. Bloomberg has learned that Apple is preparing to allow alternative app stores on its iPhones and iPads in the coming months. Shares of dating services and other such apps initially surged on the news before tapering off yesterday. Bloomberg Quick Takes Alex Webb joins us now. So, Alex, this is, if it's true, a massive sea change.
Yeah, let's be very clear. It appears as though this will be primarily in Europe. We don't really know that it's going to be rolled out elsewhere. It's a response to new European regulations that have been introduced, but they have to be followed by 2024, which designate certain big tech companies, including Apple, as gatekeepers. If you have more than 45 million active users, a market capitalization of more than $80 million or so, then you will be designated a gatekeeper. That means you have to follow certain rules, including allowing third-party app stores. This has been a huge bugbear for a lot of companies and people over the years because Apple takes between a 15% and 30% cut of every transaction that happens on its phones through the app stores. So it's a huge opportunity for companies, not least like Epic Games, who've been pushing for this for a long time, and is a massive sea change for Apple itself.
Alex, thanks very much. Alex Webb from Bloomberg Quick Take with the latest on Apple. Will that be then globally applied or just a European story? Coming up on the programme, we will get back to the macro themes. Tatiana Puhan joins us. Tobin, Deputy Chief Investment Officer. What does she make of the bear market rally? We're nearly back to bull market territory on the MSCI Asia Pacific. Where do we head here from stocks and into next year? Crucial to that will be the Fed decision. Steve Blitz joins us to talk about that. T.S. Lombard's Chief US Economist. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now, we are all prepping for the Fed today, and one of the key issues seems to be market pricing of a terminal rate. In the past, Jerome Powell has said it's going to be 4.6%. It's going to be maybe even 5%, but the market thinks it's not going to go that high. At least right now, we're looking at an expectation of just about 4.88% in the latest reading. I'm looking over to my right. Nora Melinda is here with us, Bloomberg equities reporter on set to help us figure out how this is all going to affect markets. Yesterday was crazy, right? We were off to the races, and then we kind of came back in a little bit after that CPI print.
Yes, so of course yesterday's CPI print came in lower than expected, which was a back-to-back occurrence. We had that happen with the previous print. So of course market sentiment was really boosted. Everyone was really optimistic. And then coming into the close, we trimmed some of those gains a little bit. But overall, people are really excited. And of course, this is all ahead of the Fed decision later this afternoon. So we'll just have to see how all of this plays in looking forward.
Yeah, I have to wonder how much of the fact that we saw the gains kind of dissipating into the close was a question of how how much it's really going to change anything for the Fed today, considering 50 basis points was already baked in.
Exactly. And I actually was talking to a source yesterday who said, as much as everyone's super excited, there's a lot of optimism going on yesterday. The Fed has probably already kind of come to its conclusion as to what it will be doing. And of course, most people are expecting 50 basis points today. So we'll see.
We will see. We'll see what they do today with the 50 basis points or not then, Nora, but also see what they tell us about the future. Matt started this conversation looking at expectations for rates into next year, and a lot of people talking about 23 and 24, 24 increasingly looming on the horizon. What do you think we're going to be focused on? What are equity markets going to be focused on when it comes to the Fed's dot plots today?
The dot plot will be really interesting to look at today. Of course, it only pretty much happens on a quarterly occurrence. So it'll kind of give us an idea of the Fed's expectations with the terminal rate, not only for next year, but further, as well as global economic growth. And investors were actually saying yesterday, if you looked at futures after CPI, that they are expecting the terminal rate to be right under 5% through the first half of next year, and then for rates to be cut further afterward. But if you listen to and you look at a survey conducted by Bloomberg last week, economists are saying that they're expecting us to reach the 5% terminal rate and to keep that through all of next year.
Yes, that'll be really interesting, the positioning around both the year-end dots and the expectations there and the terminal rates, not to be confused with each other. Nora, thank you very much. Bloomberg's Nora Melinda with the latest on the market positioning ahead of the Fed's decision. Coming up on the programme, Tatiana Pouhan joins us, Tobin's Deputy Chief Investment Officer. We'll get into strategy into 2023. And for more market analysis, check out MLIV Go on your Bloomberg terminal. That's the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. On Capitol Hill, budget negotiators say they've reached the framework of how to deal with a government shutdown and avert it. The compromise would end the government this fiscal year. House and Senate leaders haven't released any details, but they say the agreement would let them pass a full-year spending package by December 23rd. Meanwhile, the Biden administration is about to deepen tensions between the world's two economic superpowers. It will put China's leading maker of memory chips and more than 30 other Chinese companies on a trade blacklist. That would prevent them from buying certain American technology. Danske Bank has admitted to fraud and will pay $2 billion to end a long-running U.S. investigation. The probe has to do with money laundering at the Danish bank's branch in Estonia. Danske admitted providing banking services to suspicious customers, including some in Russia. And Elon Musk reportedly is taking drastic steps to cut costs at Twitter. According to the New York Times, Twitter has not paid rent for its San Francisco headquarters or any of its global offices for weeks. It's also considering not paying severance packages and has refused to pay an almost $200,000 bill for charter flights the week of Musk's takeover. So we continue to watch the never-ending, it seems, saga at Twitter with Elon Musk at the helm. But coming up, we will shift our focus to the wider markets ahead of the Federal Reserve's policy decision today. We'll be talking with Tatiana Pouhan coming up next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Fed's likely to downshift on the pace of tightening today, but it will probably signal that interest rates will go higher than forecast. It could be a sign that the cost of living squeeze in the UK is now past its peak. Inflation dips slightly from a 41-year high. And the former crypto mogul Sam Bankman-Fried doesn't want to return to the United States to face fraud charges. He tells a judge in the Bahamas he plans to fight extradition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, the focus clearly from the CPI of yesterday to the Fed of today onto the ECB and the Bank of England of tomorrow.
Yeah, absolutely. For U.S. markets, I think the Fed is really all that matters right now. After that CPI print, maybe they're a little bit more optimistic that step down could come or at least be announced today in terms of rate hikes. We do see futures up about 0.1%. We were up 0.7% in the cash trade yesterday to 4,019 after climbing all the way to 4,100. And then, as Nora Melinda was just telling us, trimming the losses a little bit into the close. The dollar index coming down, just continues to come down now off 8% from its all-time high. 1250 is the level for the Bloomberg dollar index. NYMEX crude, on the other hand, continues to climb. Now a 76 handle on WTI at 76.21 after we saw a 70 handle on it Monday morning. So just a couple of days boosting the price by about 6%, 7%. Right now, Bitcoin up about 0.4%, 17,832, and moving ever closer to 18,000 after a month of stability and now a pretty continued rally, although it should be noted that Bitcoin is fairly well correlated once again with risk assets. So as you know, the Fed, if the Fed decides to pause or announces something even in that direction, that's good for stocks as well as cryptocurrencies. Kailey, what do you see in the pre-market?
Well, as you talk about Bitcoin being correlated with stocks, usually it also is correlated with crypto-related equities. Yet, as we have seen some stability in the price of Bitcoin, it definitely hasn't been stable for some of those, including Coinbase, which of course is the biggest publicly listed exchange here in the U.S. It has been under more pressure. It actually fell about 9% yesterday. The concern there being that whatever comes out of the FTX hearings potentially, or the charges being filed, the repercussions of the collapse of FTX could ultimately mean rules changes that Coinbase also has to contend with. It is seeing a little bit of a rebound today, though, up about 1.8%, so recovering some of those losses from yesterday. Also adding to gains from yesterday is Moderna. This is after the results of its cancer vaccine with Merck's combination with Keytruda for melanoma actually proved that it does lower the risk of death or a repeat of the cancer coming back by about 44%, so positive results there. After a 19% gain for Moderna yesterday, it's up another 1.75% this morning. Moving lower, though, Charter Communications. This is about CapEx. It plans to spend $5.5 billion to upgrade to higher internet speeds in the coming year. That's going to weigh on free cash flow and is weighing on the stock to the tune of about 4.5%. And finally, I wanted to note Tesla as well. Already it is down 10% this week. It is down another 1% this morning. Yesterday, we saw its market cap falling below $500 billion. And of course, that is the reason that Elon Musk, Anna, is no longer the richest person in the world. That title now belongs to Bernard Arnault.
Yeah, absolutely. Luxury to the fore, French luxury specifically. Kailey, this is what we see on European equity markets then. European stocks moving lower, and it's energy markets in focus today. So the stocks are down by 0.5%. Really, we're kind of playing catch up with the Wall Street story of yesterday. Some of those late in the day losses, or at least pairing of gains that we saw on Wall Street happened after Europe closed, and so we need to factor that in. So European stocks down by 0.6% as we work our way towards the Fed. One sector, as I say, in focus is the energy sector. We've got energy stocks moving up by 0.5%, but that's really it in terms of positivity for stocks here in Europe today. Most sectors in negative territory. This is a really interesting one because on the face of it, a positive narrative to tell over at TUI, a travel operator, Germany-based. They sell holidays around Europe and beyond, and they've been telling a positive story about the way that their business is performing. But of course, they have debts from the pandemic they need to repay. Some of those to the German government and the special recovery fund that was put in place as a result of the pandemic. And so they are having to do a capital raise to fund that, and that weighs on the share. At 124, almost, I was going to say on the nose, but it just below 124 now for the pound against the US dollar. Have we seen peak inflation in the UK, just as the conversation seems to have shifted in the US over the last couple of months or so? Could we see that peak having been reached finally in the rearview mirror here in the UK as well, although at very elevated levels, still double-digit headline here, Kailey?
Yeah, and ultimately, even if we have seen the peak, it's about the trajectory and when we get down to target, which is what central banks are contending with and what traders are contending with as well. Professional and retail investors may disagree on whether to be short or long stocks before the Fed's final rate decision of 2022 today, but they are more aligned on what happens afterwards. Bloomberg's Quick Takes Scarlett Fu has the highlights from the latest MLive Pulse survey.
2022 began with the Fed and ends with the Fed. And in between, there are plenty of declines in both stocks and bonds. A year of supersized interest rate increases has given way to some clarity now that Fed Chair Jay Powell has signaled policymakers will slow the pace of those rate hikes at their final meeting of the year. But according to a Bloomberg survey, investors disagree on how to be positioned before the decision. About 2 out of 5 professional investors say it's a good time to bet against stocks, while almost the same proportion of retail investors are bullish on equities and recommend buying. Now, after the Fed's decision, both groups see stocks as the clear winner from a 50 basis point rate hike in December. And down the road, the overwhelming majority of respondents forecast a mild recession, while only 1/5 agree with Morgan Stanley that the U.S. will avoid a recession. Just as few are on board with Nouriel Roubini's expectation for a long and ugly recession. And assuming Powell ends the Fed's rate hike campaign by mid-2023 and takes a pause, 3 out of 4 respondents expect his next move to be an interest rate cut. That's probably why more than 1/3 of those agree with Citigroup's outlook that the U.S. dollar will stay strong in the near term, but then shift to a weakening phase in the second half of 2023.
Joining us now is Tatiana Puhan, Deputy Chief Investment Officer at Tobin. So Tatiana, we just heard how the Bloomberg survey indicates people are positioned. What is your position looking like ahead of the Fed decision today?
Actually, I think what we all know is that around Fed decisions, there's always elevated volatility. So potentially, could actually be a good positioning to not try to guess, whether equity markets will go up or down, but just, take advantage of elevated levels of volatility. So that's one thing, how you could play actually these Fed announcement dates.
Can I ask you about opportunities in stocks, Tatiana? Maybe you agree that this is a bear market rally that we've seen of late in to some extent, global equities. And if it is that, what is the window for stocks to go higher around the Fed downshifting its rate path, but before the market becomes too preoccupied with recession? Is that what lies ahead of us?
I think it's actually very dangerous to try to play that game and to try to position yourself, in particular stocks that you think will, take advantage for a short period of time. I think it's actually very hard to say, and you need to have a crystal ball if you want to do that. So what I would, suggest to investors to do is to have more like a longer-term view, and to try to not make, these bets that are actually out of their hands. And for me, this also means that we have to, consider from a longer perspective, what are the actual risks that are out there today in equity markets. And for me, this is a lot of downside risk that is not really priced in particular, for companies that have very high weights in those indices today.
Okay, so you see a lot of downside risk. If you're looking at the medium term then, Tatiana, is that a medium term outlook that features much higher baseline levels of inflation? I spoke to a guest from BlackRock earlier who was talking about geopolitics, demography and sustainability all being factors that will lead us, even when inflation comes back down, not back down to where we started.
Yeah, I totally agree with this view. I think it's completely underestimated, these factors such as demography, such as, climate change and sort of the way how we have to adapt to this. And this will contribute, amongst others, together, with all the geopolitical problems that we have at the same time, this will contribute to a baseline inflation rate that will remain much higher, and that will make it much more difficult for central banks actually to cope with that. And I think today this is really a sort of not really priced into markets. Another thing that I think is not really priced into markets, that's sort of a deterioration in earnings of stocks that have a very high weight in the indices, and that should adjust in terms of relative valuation with the rest of the market. And since they have such a high weight, it will have also a very big impact on those indices.
So Tatiana, bottom line, you expect equities to fall another 10 to 20% this year. That would put us at 3,600 at the top of that range, and then another 20 to 30% into 2023, 2024. So you're looking at a final range of about less than 3,000, let's say. Is that right?
Well, I'm obviously, I cannot tell you that this is exactly what is going to happen. But if we, kind of try to factor in, those risks that seem to be not really taken into account at the moment, then this is, the range that, we could see very easily. So if you just take, the rebound that we've seen in October and November, which is a rebound that I personally don't really understand where this comes from. We are already very easily at these 10%. That should be a correction in the moment in time when investors actually become again a bit more dubitative about the economic environment being positive, or a recession being mild, or even the global economy having a soft landing or whatsoever. So in the moment in time when investors change their opinion on this, a 10% downside risk is actually nothing. So this is going to happen very quickly. And longer term, again, there are lots of factors that from my perspective, haven't been properly priced in, and that should actually weigh on this asset class.
What do you think about the dollar? It's been losing strength for over a month now, and it seems that a lot of people are more bearish on the greenback than they have been throughout the early part of 2022. Does it continue to go down against the euro, against the pound?
I think it seems like the US dollar has reached a peak. That is true, but it doesn't mean that it's now, going to actually decrease a lot in value. Probably there will be some volatility around it, but very clearly, I mean, if you look at, let's say, for instance, the European Union or the European Monetary Union, there's a lot of homework, that they still need to do that they haven't done. And I don't really see the euro strengthening a lot against the US dollar. And we all know that UK has its very special problems as well. And so I believe even if, there might not be a lot of room for further upside in the US dollar, I believe that the strength of the US dollar for the next 12 months or so is something which is undoubtable.
And finally, Tatiana, if we could go to a different region of the world, to China, where for so long we have been having the hypothetical conversation about what happens if and when China reopens. It seemed that China has now just pulled the trigger and allowed a broad reopening of the economy, whatever, regardless of what happens with cases. How are you factoring that into your thinking now?
Well, obviously, the fact that China's reopening now will have a positive impact in the short run. Because it will have a positive impact, on businesses and supply chain and demand, in the Chinese market. So that's for sure like a positive factor for the global economy actually in the short run. But I think a bit longer term, we should think of China also as a potential risk factor, and as a risk factor that might come into play that is much more impactful than what we've seen happening in Russia. So whenever on the geopolitical end something happens where China and the US and the Western world in general get into further tensions, and for instance foreign investors are excluded from the Chinese market and so on and so forth, this is actually becoming like a really, really important risk factor. And so that's what is actually, from my perspective, more preoccupying at the moment, when I think about China.
Tatiana, thanks very much for your time. Tatiana Pouhan of Toban with thoughts about the global opportunities. Let's talk next about what's coming up with the Fed. Steve Blitz joins us, TS Lombard, chief US economist. We'll get his take on inflation. Have we seen then that peak in US inflation? Many people think we have. We'll get Steve's view, though. Could it be a little more nuanced? This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with former New York Fed President Bill Dudley. That's at 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey, Leinz here in New York. Anna Edwards with us out of London. Now, the Fed is set to moderate its aggressive tightening pace. News that U.S. inflation slowed more than expected last month provides support for a more moderate 50 basis point rate hike today. The Fed's announcement is due at 2 p.m. New York time. Joining us to talk about that is Steve Blitz. He is chief U.S. economist at TS Lombard. And Steve, okay, we've been expecting 50, and that's not, I think, what people are paying attention to. It's really about the outlook and the tone for what's to come in February and March and so forth.
Yeah, exactly. And honestly, by going from 75 to 50, and that's the problem with dropping down, no matter what he says, the market's going to take everything with a dovish tilt. Because if you're saying now, well, we're getting closer to the top rate, so we can start slowing down because you see the exit ahead, and you haven't really seen any real softness in labor markets or any of the things that you're talking about, everyone knows the minute you do, right, you're just going to go from plus to zero to negative in a heartbeat. So there's very little credibility in my mind, unless you really see an acceleration of growth going forward, for anyone to believe that this is nothing, this is just preamble to a cut.
Well, and of course, the cooling in the inflation data we've seen now for 2 months in a row only fuels that narrative. But it's one thing for inflation to cool. It's another for it to cool all the way down to the Fed's target. I mean, how far realistically are we away from that? Is the market wrong to be viewing things so optimistically?
Well, I think the market's wrong, but I think that's a function of age, right? Because I think most of the market has lived in a time where inflation always goes back to 2%. So I think it's a very rational view for the market to have, given their life experience. But I think that I think you hit it right on the head. I think the issue isn't deceleration, but deceleration to where? And look, the inflation was always going to decelerate. It always does in the wake of the economy decelerating, right? So you had 7% growth. You're down to, say, 2%, 3% right now. Well, that's going to slow inflation. So you're right. Where's the bottom? When's the bottom? And if a recession isn't coming, that means you're going to hit your low wherever it is in inflation sometime in the next several months, and then you're going to start lifting off again. And then where's the Fed going to be?
Right, Steve, so this is a really interesting trajectory you have in mind then. So you think that even if we've seen the peak in inflation, we start moving higher again, inflation goes higher sometime next year. What drives that?
Well, I think what drives it is what they're trying to fix, and you don't fix without a recession, unfortunately, and that is an imbalance in the labor market. I mean, you're at 3.5, 3.7% unemployment, and that's what the now sacrosanct household survey, as opposed to everybody taking down the value of the payroll survey, and that's what causes it. I mean, you really do have in the United States a true shortage of labor. The older people have left the workforce. Gen Z is smaller than millennials, and you can't import workers. So you're kind of stuck unless we're willing to accept a very large trade imbalance again going forward. But administration policy, starting with Trump, was basically built against that. So you have to have a slowdown.
Steve, Howard Marks wrote an op-ed piece in the Financial Times saying that there have only been a few sea changes in his very long career, but he sees another one now with the end of the low interest rate period that we've seen for the last 10, 20, 30 years. You mentioned an age issue, and a lot of participants in the market have never seen higher rates. Do you think higher rates are here to stay? Are we ever going back to near zero interest rate policy?
I don't think so, and that's actually what the Doves think. Right? So you look at the 2012 to 2019 period, right? Is that the new normal forever, or was that an anomaly? Because you had a 10-year period of massive deleveraging by households, even deleveraging by corporations, as opposed to the normal cycle of firms and people leveraging to spend. And so the growth rate was really supported by the Fed having to use its leverage to boost financial assets, inflation financial assets. So the question really is, what are we going back to? And the Doves and Joe Stiglitz and others, their underlying presumption is that we're going back to the economy we had 2012 to 2019. And that's really the bet. When you get through all the nonsense, the real bet, if I'm an investor, is that the world we're going back to or not? I don't think we are. I think that was going to be proven to be the anomaly, and that you're going to have a higher inflation environment simply because you're going to have more leveraged spending.
Okay, so how do you think Powell addresses this today? If you had one question to ask him at the press conference, what would it be?
What makes you so sure, given the last 2 years, 3 years of your track record, that 5.5% is the absolute top, and that's as far as you need to go? Where is this certainty, which the market's buying into 100%, where is this certainty coming from?
Steve, thanks so much. Really interesting to get your perspective. Steve Blitz of TS Lombard with his views on inflation. Yes, it might have peaked, but it might peak again. Stick with Bloomberg for our special live coverage of the Fed decision and Powell's news conference. That starts at 1:30 p.m. in New York, 6:30 p.m. in London. Our colleague Mike McKee will be there. Perhaps he'll take inspiration from Steve's question there. This is Bloomberg.